Okay, folks, welcome back. This is the third part of a discussion on changes in state of delivery, algorithmic order flow. All right, so we're going to look at the euro dollar. Again, now we're going to a little bit deeper into the price action and drop down into the hourly chart. But again, just for the purposes of showing exactly where we're focusing, this is the 2020 price run we did a complete coverage of from beginning to end, starting from the daily chart. And I'll counsel you to remember going through all the commentaries. I mentioned that by the time we got around Christmas, we would be trading up here, and this would be the draw on liquidity. And ultimately, this is what we had here. But I want to take your attention into this price run right here initially. So while all this is still fun, you have to start with the first price leg. So we're going to focus in on here, which led up to the levels we see here. So we're going to drop down into the hourly chart. So that shaded area on the daily is this segment of price action. I'm going to zoom in and I'm going to cover some salient points here, and then we'll flesh it out as we go. At the beginning of the move, the buy program, as we've been outlining in this lecture series, the idea was that we were expecting price to potentially trade up to those relative equal highs over a longer period of time, not an immediate price run. It's something that you have to obviously submit to. And on these lower time frame charts, it's fun. We can see things, get immediate reward and feedback. But the higher time frame charts, it takes a lot more time to submit to that, which is the number one reason why I said mentorship should be at least a year long, because it allows me to flesh out these really big moves, and you watch and you submit by force how long it takes for these things to pan out, and then counting all the opportunities in between these daily candles coming to these higher time frame targets, how many opportunities make themselves available to harvest pips that could be used to parlay and account equity many times over exponentially. So it doesn't mean that we have to submit to just this move, get in one time and hold it. But for those that are in the mentorship that have that disposition, that it fits very comfortably with, you can see that we can still outline these bigger moves. It just means that I'm not really interested in them because I lose interest real fast. They're boring to me. Even though there's thousands of pips available, it's still boring to me. Like, I need to see more action. So I'm like a dog chasing cars. I'm looking for the next car. So the buy program starts here, and we had obviously some consolidation down here, which is accumulation. And then we have price running through this old high. Now, classic support resistance theory would say, okay, this is an old high broken here, and if price comes back down to that level, I want to be a buyer. And that's what all the books that I bought said. Many times I tried to do that, I lost, and it would be these types of events right here. Now, I'm going to give you some homework. You can go into your own charts and dress your own chart up on the hourly and look at an indicator. And you can pull up like slow stochastic. And you can see as it traded down into that old high here, this low and this low right there created its first bullish divergence in an indicator. Now, it's blasphemy around here for me to put a chart up with indicators on it, so I'm going to avoid doing that. But for your own study, I want you to take a look at that, and you can see how that divergence right there, that would have been a trade I actually would have taken back in 1992, 1993. I would have bought this market with that idea because of the divergence, not because of what I'm going to show you here. Okay, this is the reason why what we teach is not supply and demand. It's not classic support and resistance. It's not break and retest. It's none of that stuff. Okay, it's deeper, as you'll see. So the logic is this high being ran out. That's fine and great, but I want to know, where's it going to go to? Because there's many times the market won't even come back to this old high anyway. But if it does, what am I personally looking for? Well, we're going to cover that. So the buy program starts here, and that low is the first primary reference point. So we have this low up to this high. So there's our two key price levels. So between this high and this low, we have to run a PD array matrix. So you have to find out where equilibrium is, okay? To save you the eyesore of looking at a chart with all this stuff on top of it, trust me, if you do this on your own, you'll see that this is the equilibrium price level, or 50 on the fib, all right? So we have a very bare minimum of price trading back down to the 50 level. So if we're bullish, and we're assuming that we all agree that I was outlining this year, and you can go back and watch the videos as well, we were bullish on euro, and once it trades to this price point here, that's indicating that the market is at equilibrium, or while bullish, that is discount. Okay, so at equilibrium or less, and it's bullish, that is a discount market. So at that price level here, we have to start looking at that level and below for all discount arrays. So right away, we have relative equal lows here. We have a buy side imbalance, sell side inefficiency. We have a bullish breaker, last up close candle here, and mainly the imbalance right there. Okay, so watching this low right down here, that's, well, not low, but that high rather, that's what we're going to focus on. That would completely close in this buy side imbalance. So what are we looking at? What are we seeing here? What we're seeing is the initial stages of a high resistance liquidity run, even though the market is bullish. Why is it high resistance? We had a market trade high here, then a higher high, then a higher high. So we had basically a three Indians pattern. This pattern is taught in the Street Smarts books by Linda Rasch and Larry Connors. It was one of the first patterns that I liked for reversals, but I got sucked into thinking that this was going to reverse and go down to here, because that's what classic support and resistance said, that if it can break through this old high here, like it did, that means it's going to go down to here, or here, or here, or here. That's what I gleaned from the books when I first started. Clearly, you can see we've evolved from that. Okay, so the high resistance signature is the fact that we have a high, a higher high, and now even a higher high. So all the highs are successively higher. So this was all running out liquidity, specifically seen as a return back to this displacement right here. So it returns back to rebalance, but don't lose sight of this signature here, because this is high resistance. That we'll talk about when we get further into the video. But for now, just know that this buy side delivery, it's running price higher, going to buy side liquidity here, but it's offering buy side delivery, running into buy side liquidity here. That's why sometimes when you hear me talk about, okay, it's going to run to buy side liquidity, a neophyte trader or someone just watches a hand-me-down video of me talking about runs on liquidity or relative equal highs, they assume erroneously that just because it runs above that, it's running out stops to go the other direction. No. You have to know what you're doing. You have to be able to read price and know what it is that price is doing. That's mentorship. That's what I outlined this entire year with euro. This buy side delivery, it's imbalanced. It's only been offering buy side, so it has not offered efficiently any real opportunity for sellers to trade short or offer in this range between the high here and the high of this candle, what's being highlighted with this blue line. Each high here, we have buy side liquidity here, it runs it. This high here has buy side liquidity, which it runs it as well. And then it breaks down. What's actually occurring there? This is a shift in market structure. It is not a break in market structure. Okay, it's just shifting within the context of an underlying buy program. So this low, when it was broken right there, that shifts market structure to bearish, but only on the near term. Why? So it can go back down below this low to rebalance this buy side imbalance. before it trades down there, it trades back up into a premium fair value gap. Once it rebalances that, then it's okay to see it trade lower. It trades down into that old high, which is retail resistance turn support. Does it rally? It gets a little sputter there. Then it goes a little bit lower, goes up one more time, and then drops aggressively here. So what is this occurring? It's offering a run on the liquidity that would be engineered right below these lows. So when you're looking at your charts every day, your routine should be based on what is the underlying narrative based on the things I'm talking about in the commentaries, where I'm drawing your attention. These are the things that you want to start looking at. And if you can't see it before it happens, that's fine. Go back in hindsight and fill in all the details like I'm showing you here. Now, obviously, I see these things as it's happening and before it happens, but I'm giving you the context of how you should build your own charts and also teaching you at a deeper level of why I was able to see what I was expecting in Euro this whole year. This run on these relative equal lows, the old high, the algorithm's pausing here, and it's giving the opportunity for traders to pile in and buy there. And when you see these little runs like this, stop loss orders are going to form and start pulling and congregating all underneath that low. And what kind of stops is it going to be? Sell stops, which is exactly what smart money wants to see at this imbalance. Sellers, a big crowd of willing sellers to sell at a lower price. So that's what happens. The algorithm will go down there and offer the opportunity for traders that know what they're looking for on an institutional level to buy that up. It wasn't sellers that took it down there. The algorithm's just repricing to that price point. Then traders that are aware of what's going on, they buy this. Okay? It's not the buying and selling pressure that pushes price to these levels. Because if that was the case, we would see many times these imbalances be overshot and have really no consistency. There's no symmetry. But because price is absolutely delivered by an algorithm, it's controlled down to the pipette and by time. So when you see these signatures like this, it's hard to argue with it once you really go into it and you look for it. And it might be for a new student or a layman looking at what I'm describing here, it's okay, well, you're just reading into it what you want to say, and you're torturing it, and it's obviously submitting to you with enough force, and abuse. You can make a narrative out of anything. Spend more time studying it, and you'll see right away that doesn't hold water. This is an absolutely controlled market, and all the markets now have moved to this electronic format where it's algorithmically delivered. It's efficient. They don't need a whole lot of intervention unless it's required for their personal interest. And from the central bank level, there's so many things that would cause or inspire that type of manual override, but it still once in a while will happen. Most of the time, it's autonomous and it's doing what it normally does anyway. But price trades down into the imbalance and then runs higher. Trades above this high. There's your short-term shift in market structure. Now, I don't have it identified like it does here, but this is a shift in market structure to the bullish side. What's different about that? This is short-term down to a discount. This right here is a change in the state of order flow. So there's an algorithmic transition from buy side, the market's offering buy side, and then it goes down into that buy side while it's acting as sell side. Okay, so there's a change in the state of delivery in the price where it was offered on sell side here into an area where it was only buy side. When you have that happen and the narrative is bullish, this is where the signals form. This is how you quantify the buying opportunities, whether it be a breaker, whether it be a fair value gap or an order block. The fact that the algorithm is going into an area where the state of delivery is changing to a previous state of delivery. And it's basically saying this: where there was buy side offered only, when it drops into that as sell side, that is what keys up the algorithm, and it matches up sell side delivery in an area when there was only buy side. Once that occurs and the narrative is bullish, that's when price will change on a dime and start going up. That's how you've been able to see me do these examples where I'm recording and I'm buying and it's turning right on a dime. It has very little drawdown. I'm teaching you that right here. That's what this lesson is. I'm teaching you the internals of why order blocks and imbalances constitute a setup. It's not just it's trading to an old candle. There's logic behind that. And you have to know what it is that it's doing. It's not just simply, oh, it's going back to the order block and we'll just keep it simple. No. The fact that it's got an imbalance here, why does it need to go down there anyway? Because this is efficient delivery of price, and this is what traders are looking for. They are not buying this and then driving price up because they bought it. The algorithm is already going to go up from this point here. Traders on an institutional level may miss this opportunity. That's the part you don't understand. And the people that are on YouTube or making courses and trying to rename all my stuff and think they understand order block theory, listen, you have no idea what you're talking about. Okay, you're doing more harm to people listening to you than you're helping. You sound smart, you sound like you're an ICT clone, but you have no idea what you're talking about. What I'm showing you right here is the internals of what makes that algorithm do what it's doing. How does it reprice higher? Once it does its job of rebalancing the buy side, once it does that as it goes into sell side. So it's basically saying this: the candle goes up on one singular candle. That's not efficient. But look what's doing here. It's going down multiple times, okay, in a stage where it goes down a little bit, consolidate, down a little bit. It's offering and spending time down there where sellers were being offered the opportunity to get in there. Why? Why would they want that to happen? Why does the algorithm program to do that? Because traders are going to see this as a bear flag. They're going to want to go short. Okay? They're going to sell more. Not just the sell side liquidity here, but they're going to flood the market in all of this because they're going to chase it, thinking it's going to drop lower. So they're pushing all kinds of traders' sentiment into thinking it's bearish, 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 when it's nowhere near bearish. It's all